everyone for making it out this evening. I know lots of people are out stampeding and doing various things. Okay, let's start off with a quick market update before I hand it over to Layne. So we see the total residential price here. And you can see year over year, we've had 8.5% price gain. And our total benchmark price is just over 600,000 now. And days on market, pretty typical to what you might have heard on the street. So 20 days, which is down 10% year over year. And 20 days is not the time for possession, but it's time for the firm's sale. So that includes condition period. Okay. So if you have a financing inspection, all in, that's 20 days. One good news, however, is year over year, that 25% months of inventory has gone up by 25%. But it differs across various property types. And then I put in here detached and semi-detached, so you can kind of look at the differences between them. If you look, they're about the 12% mark as far as sales price growth. However, it's a different story if you look at row houses and apartments. So benchmark sale price is almost 17% for townhouse and 17.5% for apartments. So the strongest price gains are in the lower segment of the market, the lower price points. And it's mainly driven, these price growth is mainly driven due to affordability with higher interest rates. It's driving people to the lower price points of the market. Good news is that months of inventory is going up for townhouses. And I think we could see more townhouse properties coming on the market in maybe the next 6 to 12 months because there's a lot of infill activity going on and lots of new townhouse projects on the go right now, but it takes a while for them to reach the market and be built up. So. Now I'm going to hand it over to Layne Walters, who's going to continue the rest of the presentation.
Yeah, so that's well done.
Yeah.
So yeah, as Santhosh was saying, basically really just half the slides are actually the same. I just really want to update them. And this is just the fundamentals that we should always be reviewing whatever we happen to be investing in and where we're investing. So is Calgary getting overpriced? For us that have lived here for, let's say, 50 plus years, we've never seen a market like this. We saw it flat for so long. So when you look at I still can't wrap my head around the price of a house because it was just the same price for 15 straight years. And all of a sudden now everything's more expensive. And even though I'm in the market daily, I still have a tough time kind of wrapping my head around the new prices. But then I also think, okay, with rates higher and never going back to the below 2% that we saw, and prices higher, are we getting overpriced now? Is that something that's happening in Calgary, and is it still a good place to invest? So the three things I always look at when it comes to real estate's kind of easy in some ways to predict because it happens. Like everything happens in slow motion. It's not like a stock that goes up and down daily on different news. You can see the writing on the wall in terms of population growth. You can see it in terms of affordability, which is the number one thing that I look at is affordability, that long-term cycle. When you have real estate, how much are people spending on real estate and is it sustainable? I used to think that would have to level itself out every 5 years or so. So if things were really expensive, then they'd have to come back down. What we found is that across the country, that didn't happen in a few markets, Toronto and Vancouver, where prices were going up 10% a year, but incomes were going up 2% a year. And you'd think after a couple of years, well, that's going to fix itself, but it never did for a variety of reasons. Rates coming down, provincial municipal governments increasing taxes, increasing the cost of the real estate, but then just demand in those regions, as well as a restriction of supply, kept things going for a longer timeline. But eventually you have to look at that affordability. You cannot have prices continue to double every 6 or 7 years when incomes aren't doing the same thing. So the second thing I look at it, so what impacts, housing demand, obviously population growth, job growth, those types of things, jobs in the economy kind of drive the housing demand as well. So those are the three things that I look at. The top one being the longest term. You'll eventually have to get back to some kind of mean, and demand is just how many people are actually looking, even if things are really affordable, but people are moving out of the province or out of the city that you're in, and that's expected to continue, then prices aren't necessarily going to continue to go up, even if they're already affordable. And then it's jobs, the economy, those are the things that are going to impact that. So we'll just get into a little more details of these three things. So affordability, we've seen it. So obviously on the right-hand side there is what we've seen in the last few years, mainly over COVID. So this is the orange here is Toronto. And you can see they were well over between 50 and 60 for a long time. So this is like a 10-year timeline. And we've certainly had a big bump. In Calgary, it's gone up a lot. But if you actually go back to the early 2000s, Toronto and Calgary had the same real estate prices. Like our Calgary and Toronto would go back and forth every 6 months or so on who had the second highest prices in the country. It was Vancouver, obviously, number one. They actually have both a combination of foreign money, but also geographical restrictions on where they can build. But number two and number three was typically Calgary and Toronto. But then our prices stayed flat for 15 straight years, and theirs tripled. So this is kind of the end result of that. This is another chart that this is as of this month. So this is very recent, our RBC's Affordability Index. So the average in Canada is 60, Vancouver's 100. This is pre-tax money. So this is how much pre-tax money people have to spend if they're putting 20% down buying a house. Vancouver, you have to take it with a grain of salt because number one, a lot of foreign money there. Number two is that everyone's not putting down 20%. If you've owned, most people that own a house in Vancouver have owned it for 20, 30 years, they might only owe $400,000 because they bought for $600. It might be worth $2 now, but it doesn't mean the average person, everyone's not putting 20% down buying a house. They might be moving over with 1.5 in equity from their last sale as they're buying the new property. But again, Vancouver always has been like that. It's never changed. Even when it goes up and down, it always remains higher than the rest of Canada. So Toronto, obviously, it used to be the same as Calgary. Now it's almost double. Montreal and Ottawa, this is affordability. So this again takes into account the income already. So this has already been calculated into that. So they spend about half of and this is newer growth. So this isn't historical growth like Vancouver. This is kind of stuff that's happened in the last 10 to 15 years. So they're up to spending 50% on their money. We're at 43. Edmonton obviously is almost always the lowest. So when you look at it, if we had a 20% run right now, we would still be more affordable in Ottawa and Montreal. And that's assuming our incomes didn't go up at a faster pace. And we can have an 80% increase in house prices and still be the same affordability as Toronto. Yeah, this is the benchmark price. This just gives you the difference in the actual price. This is where we are basically. And then Toronto and Vancouver again. Vancouver always high. Toronto, that's new. We make more money. The average household income in Alberta or in Calgary specifically is higher than both of these cities, and yet our real estate prices are here. So we've got room in affordability. Again, that doesn't necessarily mean anything. We were more affordable 7-8 years ago too. But if you'd have bought 7-8 years ago or 10 years ago here when we were more affordable, it doesn't mean you would have had a better return over the subsequent 5 years. And so population growth, that's where you get the demand, which drives up costs. Alberta, many of you may have heard of this stat. Alberta, if it was on its own, would have had the highest population growth in the world, including sub-Saharan Africa. Like that's how crazy it got. Those numbers don't make any sense. Obviously, we've had a really good population boom, but to beat sub-Saharan African countries for population growth, that's pretty crazy. Not a lot of signs of this slowing down a whole lot either. We know that we had a really good year last year, but this is the first quarter this year. So the numbers just came out on this. The first quarter this year, we still had an increase of 49,000. So that puts us on pace for 200,000, which is exactly what we had last year that put us ranked number one in the world for population growth. The one thing I don't actually have in this slide that I'd like to is comparing the population growth to construction and completed. So we're obviously doing a lot of construction and we're crushing records, but we're still building at about half the pace of household formation. So we would need to double our basically how fast we're building houses in order just to keep pace with inflation or with the population growth. If it continues at this pace, which up until the latest stats we have, it's still doing that. So last year we had a good year, not an anomaly year. It seems to still be happening. And of course, a lot of this is also BC and Ontario. So people from those provinces are moving here still with a pretty big kind of net number to our province from there. Canada, so top 5. So we're number 5 now, which is first time I think anywhere in Canada has been, any country or any city in Canada has made this list in the top 5. This is the top 10 most livable cities in the world. Calgary is ranked number 5. So one of the things that I like about these stats, they don't really mean anything, but Calgary is, it's a big city to us. We live here. but it isn't an international city. 10 years ago, if you asked somebody in India or China, if you walked out in the street and asked 100 people if they know where Calgary is, I guarantee you'd be lucky if you had 1 out of 100 that would actually know where Calgary is. Toronto and Vancouver, absolutely. Probably Montreal, very few people would recognize Calgary, but that has been changing in the last few years. And that's good for diversifying our economy. This was just kind of an interesting stat, which is also going to help our population. So everyone's heard about those pretend schools that have 300 square foot storefront in a strip mall, and they have 10,000 students, and they're all immigrants from different parts of the world coming here. They're really just trying to get their visa. They're pretending they're universities. They have online courses. It is really just to get visas. And they were all over Ontario and obviously causing a housing problem. So the government came in and said, okay, we're gonna shut down all these schools and allocate per real university, real colleges. So of course, big cutback. Ontario is going to lose about 100,000. So they're going from 230 to 140. British Columbia has a 18% drop, 49 to 60. These provinces are also losing about 10%. There's a few other properties that are lightly gaining as well, but Alberta is going to get a 10% increase. Like this is how many we approved this year. This is how many are expected to have next year based on these new allocations by the federal government. So even though it's impacting everyone, if you hear it on the news, they're talking about Toronto like, oh, we're cutting down on these schools. But Calgary's actually going to be a net beneficiary of that because our universities are actually offering real courses and there's still room. This is just a couple of economic forecasts. There's very few. I actually haven't seen any publication that doesn't expect Alberta to outperform the rest of the country economically over the next couple of years. And this is kind of the stats. We went over in way more detail than I'm going to do it today. Green energy, where Alberta's has the most wind and solar investment in the country, mainly because we have kind of the wind belt going through the southern part of the province, and then we have the southern Alberta is the sunniest place in Canada, including Calgary being the sunniest city. Agribusiness has been huge in the last few years. Film industry, I don't think that's growing anymore, but we had a big kind of growth spurt there. Aerospace, de Havilland, this is the one that actually I like the most not because I like aerospace, but because Alberta doesn't have an aerospace industry, never has. We're also not a manufacturing base. So why would a company like de Havilland decide to move all of their offices and set up a head office in Alberta? They didn't get $17 billion from the Alberta government or the federal government. They did it because this is a good place to do business. So if you're entrepreneurial, the bureaucratic structures, everything is designed to be pro-business in this province. And they decided that was enough for them to relocate, build an airstrip beside an already huge airstrip, and do both research and their manufacturing out of Alberta. Logistics, obviously we have probably the best airport logistics-wise, probably one of the best in the world, definitely the best in North America. We have an airport that's surrounded by land. That's rare. Most places are surrounded by the city or next to an ocean. The only thing we don't have is tidewater. Otherwise, it would be like logistics for highways, train, everything else. We're set up very well. And then again, just the capacity to build out commercial around our airport is significant, which we've seen even during our downturn from 2015 to 2020, let's call it. Logistics was growing at 10% a year just because of that new airstrip that we have. Tech and specifically fintech are where our growth has been. We've over 50,000. We're now considered a large tech hub instead of medium or small because we hit that 50,000 in our workforce. This has made up the biggest increase in our new business. So the 100,000 employees we lost at oil and gas, we gained 120 people or 1,000 employees or employment positions since then. A lot of it was in fintech and tech. And that does make sense with the industry. We had statisticians working for oil and gas companies. They already had math degrees. They already knew how to code. They were an easy workforce to shift over into tech. Everyone wants tech, but it's hard to get a Detroit or Windsor grade 8 educated factory worker to shift over into all of a sudden doing tech that requires a lot more technical capacity. Oil and gas, I scratched this one out last time because oil and gas we didn't have any growth. Our capital expenditures in oil and gas has been basically the same last year as it was between 2016 and 2019. For that 4 years, where oil prices were crushed and we'd lost all those employees, our CapEx isn't any higher. We're making more money. So, but we've gone from an expansion of production province to just the production province. So we're no longer building new big facilities, although that's now starting to happen again. So basically, take that oil and gas is actually, you deleted that slide. Oil and gas is basically, there is, this somewhat explains it. Basically, we're starting to see some incremental increases with Trans Mountain now done. Not only are we going to get more in terms of our Western Canadian Select oil price, which is good for the government, which is then good for their ability to support other business and diversify our economy. But it actually is starting to increase. There's a little bit more activity in oil sands. All of it's incremental. All the big infrastructure has been built, so we're not having any more, $13 billion plants being announced, but we're still getting kind of incremental growth as we go. Tech sector, I already kind of touched on that. We're ranked 12th in the world for growth. Only Canadian city to make the list. Tech startups, this is an article from the end of last year, I think, so nothing new about that, but again, just for somehow everyone wanted to be the next tech something, and Calgary's actually been able to grab a big part of that. 6.9%, probably a little higher than that now. That's a pretty big part of the workforce, actually, in terms of an initial body, because when you develop tech, you're not, if you're manufacturing something, you have to import parts from somewhere, and then you sell them, and whatever you sell, you had to buy 90% of it in the first place. When it's like a service like tech or like oil and gas, the same thing, you're selling you get 100% of that revenue. So a service like tech, so this is actually a good industry with high-paying jobs to replace our high-paying oil and gas jobs. This isn't necessarily a good thing for people in the rest of the country, but the Toronto and Vancouver, they're going to have it rough for the next few years, specifically, I think, Toronto, or actually all of Ontario, I should say. But that's actually, in a way, kind of good for us in our real estate market. 2/3 of Canada's economy is consumer spending. That's pretty normal. The US is about 70%. We might be higher than 67%, but somewhere in that range is about how much consumer spending makes up of our GDP. Now, the largest consumers, as you could guess, are also the largest mortgage holders. The young people that have just started working, haven't saved enough to buy a house, so they have to borrow the money for the house. But they have young families. They have a lot of things to spend money on, but they haven't saved it yet. Those same consumers that make up the bulk of our consuming and consumption are also the people with the biggest mortgages. So we're about to see in Ontario and Vancouver and BC, you have that was 50% of the mortgage. Toronto and Vancouver, basically, or Southern Ontario and Vancouver, made up 50% of the mortgages done in 2020 and 2021. And those mortgages were all being done at under 2%. So when you look at those mortgages, the biggest consumers are about to have their interest rate go from 1.59 to 4.79. It's a tripling of their interest rate. So let's say their payment, that's almost a doubling of their payment. So let's say they can handle, somehow they decide or figure out a way to not go into default. Hopefully that doesn't happen. But they're able to save $2,000 a month to put towards their interest. But where's that going to come from? It's going to come from consumer spending. There's no other way to look at it. So that's less that they spend at restaurants, less that they spend on their kids. They're going to buy less cars. They're going to give less money to their stockbroker, who then has less money to pay a junior stockbroker, who then have to have accountants, and then the accountants have to have junior accountants, and then they all need a tailor to buy their suits. And you can see that that first kind of top consumer spending actually feeds into the economy over and over, because the tailor buys cars, and then the car salesman gets an addition put onto his house. But as that kind of top number that was a result of actually borrowing is now going to have to be kind of paid back, or is just going into now servicing interest, it's going to crush the economy in Ontario. The government can't manage that. There's just no way we can. So they are going to lower interest rates. I had my guess at 12 to 18 months from when we did this last October. So I still suspect that we're going to start to see the increases towards the end of this year. And then the first half of next year is when interest rates are going to drop the biggest amount, because that is when those people buying $900,000 townhouses, that's 5 years from their renewal date of either their 5-year fixed or variable mortgage with a fixed payment. Those payments are going to increase $2,000 a month unless the government does something to either buy into the bond market to lower fixed rates or lower the overnight lending rate or variable rates. I think they're going to do both. But what that does for Calgary is, even if our market's booming and we don't need relief, we actually probably should be suppressing our market a little bit. We're not going to need the stimulus. They don't really care about us. They didn't care when things are bad. They won't care when things are good. And, well, it's true. And we also only make up 12% of the population. So they can't make a decision based on what's happening here. They have to make a decision on what's happening in Ontario. So they're going to have to mitigate that somehow by lowering the interest payments. They're trying to figure out ways to re-amortize and do different things. But ultimately, they're going to be lowering rates both on the fixed side or the variable side, or doing their best to do it. And any government's kind of stuck in the same position. But the government likes inflation, to be honest with you. They just don't like when it impacts them electorally, because the way a government pays off debt is either by raising taxes, which is never popular and never good for the economy, cutting services, which is no one's even heard of that in the last 20 years, or they can inflate it away. They print 20% or 30% more money to represent the same amount of goods and services. It's basically the definition of inflation. They have devalued money by 30%. But if they do that, they've effectively paid off 30% of their debt without having to raise taxes, without having to cut services. Now, people end up having to pay more. So what's happened now is people have noticed that they've been doing that because they got carried away with it. So now they're feeling a little bit of pain from it, but it's still what has to continue. They're going to lower it. They're going to figure out a way to call 4.5% inflation 2%, and they're going to lower it from the current highs, so it won't feel quite as bad. But inflation is still necessary for whatever government happens to be elected during the next election cycle. So I do think this current government is going to have more inflation, but even the next government's going to have to deal with it. And they're going to have to deal with it in the US as well. I don't think there's really a way around it. And that's about it. So the gist of that is that we're probably going to see relief in our payments here, and affordability is going to get even a little bit easier here, even though we're relatively affordable. So ultimately, it's better to have invested 2 years ago, but it's still not a bad time to invest here. I certainly wouldn't want to be investing anywhere else in the country right now. Any questions?
If you had a question, would it want you would want or not to be
Well, if I could go back in time to 2007, I would have rather invested anywhere but here, right? Just historically, like, I would have done better anywhere else. But being here now, I think we're fortunate. Calgary just has low affordability. We've got everything on the upside. We went through a lot of pain for a long time, but now we're positioned well, including affordability, there's more empty commercial real estate downtown than there in Calgary than there's total real estate in Vancouver, like in terms of commercial real estate. So when companies are looking to move here, whether it be a tech company or some other non-related, they're looking not only at how little they can pay for their space here, that they can be pretty confident that in another 5 years that they're not going to run out. They're still going to continue to rent for the next, couple of decades, probably at a reduced rental rate compared to if they were in Vancouver or Toronto. And they can, at this point, also pay their employees a lot less, so their employees can start a family and get a yard and put a couple of kids in school and are less likely to leave than if they're at some one-bedroom condo for $900,000 in Toronto. They're a more stable employee. So there's a lot of reasons that all of that's good for us, that it has been bad. Again, I wish I had invested somewhere else, but now I can't think of anywhere else I'd be, like, if I was in Toronto, I'd be probably looking to sell everything. Like, I don't know how comfortable I'd be at that level, knowing that historically there was no real reason for Toronto to be at that level. So one of the problems in Toronto, they have geographical barriers with water and mountains. In Toronto, in Vancouver, geographical water and mountains. Toronto, it's just made up. They have a green belt that it's like, hey, we're just going to call this a park and nobody can build there. And
artificially restrict.
Exactly. They pretended there was no more land to build, but there is lots of land there. And Doug Ford, during his first election, actually announced during the campaign, said, well, I'd entertain if someone's going to, take 10 acres out and build a community and build housing on this side of the green belt, and they replace it with 20 acres somewhere else and make the green belt larger as a whole, I'd entertain that. And there was such a backlash that he backed off of that. But now the federal government first started with the Conservative government saying that this is what should happen. Now the current federal government saying this is what should happen, and implementing saying you guys have to get better with your regulation. And there's now the federal government. So now both municipal and provincial governments can just blame the federal government, say we're not going to get any infrastructure money unless we build in the green belt. So we have to reverse this policy and let people build housing. And so there's going to be, once that gets unleashed, we're going to see a lot of capacity for them to build. And are they going to come back to a median, like an income of their long-term range back to kind of where Calgary is? And partially, we're probably going to come up a little bit. They're probably going to come back down a little bit. So yeah, that's why I'd say I'm more comfortable here. Again, I basically invested in the worst place to have invested in real estate from 2007 until a few years ago. That's where I invested all my money because that's where I happen to live. Now, having said that, it does bode well for the buy and hold strategy, is that it just takes longer. Like, I can hold on when things are bad. If you leverage yourself in commodities and everything goes wrong, you get as bad as I did, you get crushed. Not only do you lose your entire investment, you go bankrupt. Whereas here it's like with your buy and hold, buy for cash flow, kind of boring. But if there's a downturn, I just have to wait it out. So it took 15 years, but this is the benefit of a buy and hold strategy. So, I mean, if you're still inclined and you can cash flow in Toronto and or maybe not lose that much money, then you might want to hang on to a property, but there might be better places to deploy capital at this particular time in 2024. Perfect. I think we'll just wrap it up. Yeah.